Hi, my name is Rajat and welcome to another show with BugleRock. We've been discussing about taxation and we have been simplifying the taxation laws so that it becomes very easy and understandable for any investor or trader. So let's look at what we're going to cover in this particular module. So in module one, we spoke about various different categories, tax categories. So basically what we did was we broke down the tax laws and bucketed into various different categories. In module two, we're going to talk about two of those categories, the short-term capital gains as well as the long-term capital gains. We're also going to talk about indexation, which benefits, which reduces your tax outflow if you have invested in debt funds. So we had introduced these four categories in module one. In this module, we're going to talk about only short-term capital gains as well as long-term capital gains. We also are going to talk about indexation, which applies to debt funds. So both these categories is applicable to investors who invest in equity mutual funds. It could be a debt mutual fund, it could be an equity mutual fund, or it could be a hybrid mutual fund. So we're going to talk about all the taxation laws that govern the short-term capital gains and long-term capital gains for equity and debt-related products. So both under long-term capital gains and short-term capital gains, there are two big buckets based on the asset, the type of asset. On one side, you have everything to do with equity related. So you have stocks, equity mutual funds, and hybrid equity oriented funds. In the second bucket, you have all debt related products. So debt mutual fund, hybrid debt oriented mutual funds fall into this category. So if you have invested in a hybrid fund, it is important to know whether it is equity oriented or debt oriented, because the taxes that is applicable is completely different for depending on the category it falls under. So it is always nice when you are making that investment to know which category it falls into. Now let's look at the equity bucket first and then move on to the debt side of things. Under the equity bucket, so any gains or losses from any equity related assets is classified as long-term capital gains only if that asset is held for more than 1 year. So if you have a stock and if you held it for more than 1 year, then any gains or losses arising from that particular stock is categorized as long-term capital gains. The tax laws are very simple. Up to 1 lakh every financial year, up to 1 lakh, any long-term capital gains is tax exempt. So you don't have to pay any taxes up to 1 lakh. So we encourage viewers to take advantage of this provision and book gains, long-term capital gains up to 1 lakh if wherever possible, either from stocks or mutual funds, because there's no taxes that you need to pay. So might as well take advantage, and this is applicable every year. So you can book gains up to 1 lakh, and if you're interested, you can go back and reinvest that profits that you've earned back into the same stock or the same mutual fund. So that way, your investment is not disturbed. Anything over 1 lakh, you need to pay a flat taxation charge of 10%. There's additional cess and surcharge that is applicable. So up to 1 lakh every financial year, long-term capital gains, you don't have to pay any taxes. Above 1 lakh, you have to pay a tax of 10% plus surcharge plus cess. Any losses that is arising from long-term capital gains can be carried forward for up to 8 years. However, the important thing is long-term losses can be only offset against long-term gains only. So this is a very critical important. So if I have made losses this year, next year I can only offset this losses against any long-term capital gains I see in my account. Now let's move to the debt funds. Under the debt funds, under the debt category, right, you classify any gains and losses as long-term capital gains if you've held the asset for more than 3 years. Under equity, it was just 1 year, but for debt related products, it is up to 3 years. You need to you have to hold this asset for more than 3 years to have that gains or losses classified as long-term capital gains. If you hold it for more than 3 years, you get indexation benefits, which is significant, and we're going to talk about it in a couple of slides later. And after indexation, you have to pay a tax of 20% with plus flat tax of 20% plus a 12% surcharge and a 4% cess. So the net tax that you pay on debt funds after indexation benefit is about 23.296%. It's very rare that you are going to be making losses on debt funds, but if at all there is a chance, if that's the case, then you can again carry forward these losses for 8 years. The same rules as in case of equity. The long-term losses can be offset only against long-term gains. So short-term capital gains, the buckets are very similar to the long-term capital gains. The rules that's applicable to equity and equity-related products is different, and debt-related products are different. So let us first look at the equity-related products. So any gains or losses that is arising from equity-related asset which is held for less than 1 year is classified as short-term capital gains. So more than 1 year, it falls under long-term capital gains. Anything less than 1 year, it falls under short-term capital gains. Here there is no tax exemption as we saw in long-term capital gains. Here any gains, the tax is flat 15% plus surcharge and plus cess. So you need to pay out a flat taxation fee of 15%. Again, just in case of as in case of long-term capital gains, you can carry forward losses for up to 8 years. However, with short-term losses, it can be offset against both long-term capital gains as well as short-term capital gains. So if I have any losses, any short-term losses this year, and I have long-term capital gains next year, I can offset this short-term losses in this financial year against the long-term capital gains next financial year. So that is a small advantage that we have with regards to short-term capital gains. Now let's come to the debt side of things. So any gains and losses that is arising from debt related asset classes where the holding period is less than 3 years is classified under short-term capital gains. Anything more than 3 years is classified as long-term capital gains. If you gains or losses from short-term capital gains do not get the indexation benefit. If you remember, for long-term capital gains we had the indexation benefit. So for short-term capital gains you do not get that indexation benefit. So any gains from this asset classes is added to your income and you're taxed at your income tax bracket, overall income tax bracket. So if you fall under the 30% tax bracket, so you have to pay 30% tax plus cess plus surcharge for the short-term capital gains as well. So and if your tax bracket is 20%, tax of 20% is applicable. The important thing is you do not get the benefit of indexation for short-term capital gains. Same rules of carry forward rules apply. So you can carry forward any losses up to 8 years and you can offset short-term losses against long-term gains and short-term and long-term gains as well. Now let's look at indexation that we spoke about a little while back and how it is calculated and what is the benefit. However, I would like to pause here. Any of the if you input all of your gains into any software, it will automatically calculate the indexation benefits. So you don't really have to go through this particular section and jump straight to the last section where we're going to talk about what ITR that needs to be filed. But you're still curious how indexation benefits you, how it reduces your tax outflow, then stick on and watch this particular section. Let me tell you, it gets a little mathematical, but it's interesting, and if you have a keen mind, then you probably want to see how this benefits you. So indexation is a methodology by which you can protect your returns from the impacts of inflation. As you know, current in India, the inflation is about current inflation is about 5 to 6%. So this impacts your true wealth creation over time. So how do you overcome this impact? We are going to adjust. In fact, we're going to increase the purchase price of your asset to take care of the impact of inflation. So if you have inflated or if you have increased your purchase price, that means the profit calculation is reduced, and thereby the tax on that profit is reduced as well. This indexation benefit is applicable only for debt and hybrid oriented debt funds after a holding period of 3 years. So this indexation benefit comes into play only for long-term capital gains and not for short-term capital gains. It is in fact this indexation that makes investment into debt funds or hybrid debt funds a better and more efficient alternative to fixed deposits. So all the details with regards to indexation is available on income tax website, so you can review it. I have provided the link, and the link is also provided in the description. So now let's look at how we calculate that the purchase price. How do we adjust or how do we increase the purchase price to take care of the inflation? There's something called cost inflation index, which is published by RBI, and that is available in the Income Tax India website. This cost inflation index kind of reflects the inflation in any financial year. So since inflation is increasing, the cost inflation index year over year has been increasing as well. So in order to calculate our indexed or adjusted purchase price, we're going to take the actual purchase price and multiply it with the cost inflation index in the year of sale, and then divide that by the cost inflation index in the year of purchase. As you know, since cost inflation index is increasing, the cost CII in this year of sale will be higher than the year of purchase. So as a result of which we are actually increasing the purchase price. You're inflating the purchase price. Since the purchase price, the increased or the index purchase price is used to calculate the P&L, that reduces the profits, that also reduces the tax outflow. Now let's take an example and look at the details. So now let's quickly look at an example and quickly understand how this indexation benefits the tax outflow and the total return that we get. So let's assume that we have invested in a debt fund in 2018-19. The NAV was about 530. We purchased about 400 units, so that's a total investment of 2 lakhs. Let's also assume that we sold that in the current financial year at 650 rupees. So that's a period of more than 3 years. So we are now applicable for long-term capital gains as well as the indexation benefit. So the total sale from this particular fund is 2,60,000. So that's a gain of 60,000. So cost inflation index, again, this is obtained from the income tax website. In 2021-22, the CII, the cost inflation index, is 317, and the cost inflation index in 2018-19 was 280. So the increase accounts for the increase in inflation over the last 3 years. So let's look at how we calculate the profit and loss with indexation. So what is our index price? As we discussed earlier, we're going to multiply our purchase price, which is 530, multiply it with the CII of the current financial year, the year of sale, that is 370, and then divide that by 280, which is the CII or the cost inflation index when we purchase. So that is 2018-19. So the new purchase value or the index purchase value is now 566, which is significantly higher than our purchase price. Our actual purchase price was 530. Indexed purchase price that we're going to use for calculating our profits is at 566. So the long-term capital gains, as I told you, we are going to use the index purchase price, the higher indexed purchase price. It comes up to 33,000. Our net gains was about 60,000 without indexation. So the tax liability, as we discussed, for long-term capital gains is at 23.296%, which includes cess and surcharge. So the tax liability is about 7,800 rupees. The net gains from this entire transaction stands at 52,180 rupees. If we didn't take advantage of indexation, like for instance, if you had invested the same amount in an FD and assuming you got the same kind of returns as a debt fund, the gains would be 30%, that is 60,000, and you would have had to pay tax at 39.9%, assuming you fell in the tax brackets of the 30% tax bracket. So including cess and surcharge, your net tax percentage would be 30.9. So the tax liability would be 18,000 rupees, whereas with indexation, the tax liability was only 7,800. So the net amount that you gained was just 51,000, whereas with indexation, the gains that you got was 52,000. So this is how indexation and investments in debt funds over a long period of time benefits us. So finally, at the end of it, which tax returns that you file, it is very simple. You go and file the ITR1. So if you are a simple investor who trades only in equity and mutual funds, all you have to do is file ITR1 and your job is done. If you're not an FNO trader and if you're not an equity day trader, you can jump to module number 5, where we talk about advanced tax and the mechanisms involved in advanced tax. If you are a FNO trader or if you're an equity day trader, do check out the other 2 modules as well. If you liked what you watched, do subscribe to our channel. We share a lot of information with regards to investing, trading, as well as the taxation laws that govern these 2 segments. If you think that this was beneficial, do share this video so that more people can benefit from it. Again, thank you for watching. Look forward to seeing you in our next video.